Hello, and welcome to the 8D Sleep Lab. Before we begin our descent into the archives, I have a mandatory request. This session utilizes bilateral 8D audio technology. To experience the full physical effect of the sound moving around you, headphones are required. Please, secure them now. If you are new to the lab, understand that tonight, we are not looking for excitement. We are looking for order. We create deliberately boring technical soundscapes designed to occupy the logical part of your brain without stimulating it. There is no plot to follow. There is no drama to resolve. There is only the steady, rhythmic processing of data. Find a position that allows your body to power down. Unclench your jaw. Drop your shoulders. Let the bureaucracy wash over you from ear to ear. Initializing the Legal Archive. Chapter 1. The Enactment, the Origins of Bureaucracy. The Legal Archive, File 1. The Internal Revenue Code of 1954. We begin with the enactment. This massive statutory document was officially signed into law on August 16, 1954. The time was 9:45 in the morning. It superseded the Internal Revenue Code of 1939, aiming not to simplify the law, but to reorganize it into a permanent industrial structure. The text itself occupies thousands of pages of thin government issue paper. It smells of dust and ink and binding glue. In these pages, there is no emotion. There is only the law. Let us read the official enactment. Public Law 591. Chapter 736 of the 83rd Congress of the United States, Second Session. An Act to revise the Internal Revenue Laws of the United States, be it enacted by the Senate and House of Representatives of the United States of America in Congress assembled. Section 1. Short Title. A. Short Title. This Act, with the following table of contents, may be cited as the Internal Revenue Code of 1954. B. Citation. No inference, implication, or presumption of legislative construction shall be drawn or made by reason of the location or grouping of any particular section or provision or portion of this title. C. Separability Clause. If any provision of this title, or the application thereof to any person or circumstances, is held invalid, the remainder of the title, and the application of such provision to other persons or circumstances, shall not be affected thereby. Section 2. Closing of 1939 Code. The Internal Revenue Code of 1939 is hereby repealed, except as provided in Section 7851 of this title. The machine is now active. The old rules are dead. The new rules are absolute. Let us examine the architecture of the obligation. The code is divided into 7 major subtitles. Subtitle A. Income Taxes, Sections 1 to 1563. Subtitle B. Estate and Gift Taxes, Sections 2001 to 2524. Subtitle C. Employment Taxes, Sections 3101 to 3504. Subtitle D. Miscellaneous Excise Taxes, Sections 4001 to 4907. Subtitle E. Alcohol, tobacco, and certain other excise taxes, Sections 5001 to 5005. 7862. Subtitle F, Procedure and Administration. Sections 6001 to 7852. Subtitle G, the Joint Committee on Internal Revenue Taxation. Sections 8001 to 8023. This is the skeleton of the state. A vast interlocking grid of liabilities. We shall focus our attention tonight on Subtitle A, the taxation of income. To understand the scope of this subtitle, we must read the hierarchy of its chapters. Chapter 1. Normal taxes and surtaxes. This chapter defines the burden placed upon the wages of the individual and the profits of the corporation. Chapter 2. Tax on self-employment income. The obligation of the independent. Chapter 3. Withholding of tax on non-resident aliens and foreign corporations. The capture of value. Crossing the border. Chapter 4. Rules applicable to recovery of excessive profits on government contracts. The reclamation of surplus. Chapter 5. Tax on transfers to avoid income tax. The prevention of escape. Chapter 6. Consolidated returns. The aggregation of entities. Let us descend further into the fractal structure of Chapter 1. Chapter 1 is divided into subchapters. A through W. Subchapter A, determination of tax liability. Subchapter B, computation of taxable income. Subchapter C, corporate distributions and adjustments. Subchapter D, deferred compensations, etc. Subchapter E, accounting periods and methods of accounting. Subchapter F, exempt organizations. Subchapter G, corporations used to avoid income tax on shareholders. Subchapter H, banking institutions. Subchapter I, natural resources. Subchapter J, estates, trusts, beneficiaries, and decedents. Subchapter K, partners and partnerships. Subchapter L, insurance companies. Subchapter M, regulated investment companies and real estate investment trusts. Subchapter N, tax based on income from sources within or without the United States. Subchapter O, gain or loss on disposition of property. Subchapter P, capital gains and losses. Subchapter Q, readjustment of tax between years and special limitations. Each subchapter is a room. Each room contains a list of rules, and in each room there is a silence, waiting to be filled with numbers. We conclude the enactment by reading the initial regulations regarding the definition of the taxable year. Part 1. Definitions. Section 4, 41. Period for computation of taxable income. A. Computation of taxable income. Taxable income shall be computed on the basis of the taxpayer's taxable year. B. Taxable year. For purposes of this subtitle, the term taxable year means 1. The taxpayer's annual accounting period, if it is a calendar year or a fiscal year. 2. The calendar year, if the taxpayer keeps no books or has no other annual accounting period. Or 3. The period for which the return is made, if a return is made for a period of less than 12 months. C. Annual accounting period. For purposes of this subtitle, the term annual accounting accounting period means the annual period on the basis of which the taxpayer regularly computes his income in keeping his books. D. Calendar year. For purposes of this subtitle, the term calendar year means a period of 12 months ending on December 31st. E. Fiscal year. For purposes of this subtitle, the term fiscal year means a period of 12 months ending on the last day of any month other than December. In the case of any taxpayer who has made the election provided by subsection F, the term means the annual period varying from 52 to 53 weeks, so elected. F. Election of year consisting of 52 to 53 weeks. 1. General rule. A taxpayer who, in keeping his books, regularly computes his income on the basis of an annual period which varies from 52 to 53 weeks, and ends always on the same day of the week, and ends always, A. on whatever date such same day of the week last occurs in a calendar month, or B. on whatever date such same day of the week falls which is nearest to the last day of a calendar month, may, in accordance with the regulations prescribed by the Secretary, elect to compute his taxable income for purposes of this subtitle on the basis of such annual period. This is the definition of time. Chapter 2. The definitions, the persons of the law. The Legal Archive, File 2, Section 7701, Definitions. We move now to the naming of things. Before the law can tax, it must define what exists in the universe. It must label the entities, the relationships, and the boundaries of reality. Subsection A. When used in this title, where not otherwise distinctly expressed or manifestly incompatible with the intent thereof, the following definitions shall apply. Item 1. Person. The term person shall be construed to mean and include an individual, a trust, estate, partnership, association, company, or corporation. In the eyes of the Code, a corporation is a person, a trust is a person, you are a person. Item 2. Partnership and partner. The term partnership includes a syndicate, group, pool, joint venture, or other unincorporated organization, through or by means of which any business, financial operation, or venture is carried on, and which is not, within the meaning of this title, a trust or estate or a corporation. The term partner includes a member in such a syndicate, group, pool, joint venture, or organization. Item 3. Corporation. The term corporation includes associations, joint stock companies, and insurance companies. Item 4. Domestic. The term domestic, when applied to a corporation or partnership, means created or organized in the United States, or under the law of the United States, or of any state or territory. Item 5. Foreign. The term foreign, when applied to a corporation or partnership, means a corporation or partnership which is not domestic. Item 6. Fiduciary. The term fiduciary means a guardian, trustee, executor, administrator, receiver, conservator, or any person acting in any fiduciary capacity for any person. Item 7. Stock. The term stock includes shares in an association, joint stock company, or insurance company. Item 8. Shareholder. The term shareholder includes a member in an association, joint stock company, or insurance company. These are the atoms of the commercial world, separated, labeled, and indexed. We continue with the definitions of place and obligation. Item 9, United States. The term United States, when used in a geographical sense, includes only the states, the territories of Alaska and Hawaii, and the District of Columbia. Item 10, State. The term state shall be construed to include the territories and the District of Columbia. Item 11, Secretary. The term secretary means the Secretary of the Treasury. Item 12, Delegate. The term secretary or his delegate means the Secretary of the Treasury or any officer, employee, or agency of the Treasury Department duly authorized by the Secretary. Item 13, Commissioner. The term commissioner means the Commissioner of Internal Revenue. Item 14, Taxpayer. The term taxpayer means any person subject to any internal revenue tax. Note the circularity. If you are subject to the tax, you are a taxpayer. If you are a taxpayer, you are subject to the tax. Item 15, Military or Naval Forces of the United States. The term military or naval forces of the United States includes the Marine Corps, the Coast Guard, the Army Nurse Corps, female, the Women's Army Auxiliary Corps, the Navy Nurse Corps, female, and the Women's Reserve Branch of the Naval Reserve. Item 16, Withholding Agent. The term withholding agent means any person required to deduct and withhold any tax under the provisions of Chapter 3. Item 17, Husband and Wife. As used in Sections 71, 152, and 215, if the husband and wife therein referred to are divorced, wherever appropriate to the meaning of such sections, the term wife shall be read former wife, and the term husband shall be read former husband. The law accounts for separation. It accounts for the dissolution of the union, but the tax remains. We conclude the definitions with the abstract concepts of inclusion and internationality. Item 18, International Organization. The term international organization means a public international organization entitled to enjoy privileges, exemptions, and immunities as an international organization under the International Organizations Immunities Act. Item 19, Domestic Building and Loan Association. The term Domestic Building and Loan Association means a domestic building and loan association, a domestic savings and loan association, or a federal savings and loan association, substantially all the business of which is confined to making loans to members. Item 20, Employee. For the purpose of applying the provisions of Chapter 21 to this title, the term employee includes an officer of a corporation. Item 21, Levy. The term levy includes the power of distraint and seizure by any means. Item 22, Attorney General. The term Attorney General means the Attorney General of the United States. Item 23, Taxable Year. The term taxable year means the calendar year, or the fiscal year ending during such calendar year, upon the basis of which the taxable income is computed under Subtitle A, Item 24. Includes and including. The terms includes and including, when used in a definition contained in this title, shall not be deemed to exclude other things otherwise within the meaning of the term defined. This is the final catch-all. The list is never closed. The definition is never truly finished. The law reserves the right to include more. We extend the definitions to the concepts of timing and public office. Item 25. Paid or incurred. The terms paid or incurred and paid or accrued shall be construed according to the method of accounting, upon the basis of which the taxable income is computed under Subtitle A. If the books are kept on cash basis, paid means cash departed. If the books are kept on accrual basis, incurred means the obligation is fixed. Item 26. Trade or business. The term trade or business includes the performance of the functions of a public office. Even the state itself is a business. Item 27. Tax court. The term tax court means the tax court of the United States. Item 28. Other terms. Any term used in this subtitle which is not otherwise distinctively defined shall be defined as provided in the general legal statutes of the United States. Item 29. Internal Revenue Code. The term Internal Revenue Code of 1954 means this Act and the amendments thereto. Let us refine the definition of the Secretary. Section 7701A 11B. Any reference in this title to the Secretary shall be deemed to refer to the person holding the office of Secretary of the Treasury or his delegate. This creates the chain of command. The authority flows from the statute to the Secretary, to the delegate, to the agent, to you. We conclude this file with Section 7704, Rules of Construction. Subsection A, Cross-references. The cross-references in this title to other portions of the title or to other provisions of law where the word see is used are made only for convenience and shall be given no legal effect. Subsection B, singular and plural. In this title, unless the context indicates otherwise, Item 1. The singular includes the plural. Item 2. The plural includes the singular. Subsection C, masculine and feminine. In this title, unless the context indicates otherwise, terms implying the masculine gender shall be considered to include the feminine gender. And finally, Section 7503, Definition of legal holiday. When the last day prescribed under authority of the Internal Revenue Laws for performing any act falls on Saturday, Sunday, or a legal holiday, the performance of such act shall be considered timely if performed on the next succeeding day, which is not a Saturday, Sunday, or a legal holiday. For purposes of this section, the term legal holiday means a legal holiday in the District of Columbia. These include January 1st, New Year's Day, January 20th, Inauguration Day, February 22nd, Washington's birthday, May 31st, Memorial Day, July 4th, Independence Day, the first Monday in September, Labor Day, November 11th, Veterans Day, the fourth Thursday in November, Thanksgiving Day, December 25th, Christmas Day. The calendar is fixed. The definitions are set. You are now located within the grid. Chapter 3, Section 61, the Inventory of Gross Income. The Legal Archive, File 3, Section 61. Gross income defined. We arrive now at the center of the code. This is the net, which captures every form of economic gain. Subsection A, General Definition. Except as otherwise provided in this subtitle, gross income means all income from whatever source derived, including, but not limited to, the following items. Item 1. Compensation for services, including fees, commissions, and similar items. Item 2. Gross income derived from business. Item 3. Gains derived from dealings in property. Item 4. Interest. Item 5. Rents. Item 6. Royalties. Item 7. Dividends. Item 8. Alimony and separate maintenance payments. Item 9. Annuities. Item 10. Income from life insurance and endowment contracts. Item 11. Pensions. Item 12. Income from discharge of indebtedness. Item 13. Distributive share of partnership gross income. Item 14. Income in respect of a decedent. Item 15. Income from an interest in an estate or trust. Let us descend into the regulations to define the specific mechanics of these items. Regulation 1.612. Compensation for services. Subsection A, in general. Wages, salaries. Commissions paid salesmen. Compensation for services on the basis of a percentage of profits. Commissions on insurance premiums, tips, bonuses, termination or severance pay, rewards, jury fees, marriage fees, and other remunerations for services of whatever kind are income to the recipients. Subsection B. Members of the armed forces. The value of quarters or subsistence furnished to the commissioned officers, chief warrant officers, and enlisted personnel of the Army, Navy, Coast Guard, Coast and Geodetic Survey, and Public Health Service, or amounts received by them as commutation of quarters, are to be excluded from gross income. However, pay for service is gross income. Subsection D. Compensation paid other than in cash. If services are paid for with something other than money, the fair market value of the property or services taken in payment must be included in income. If the services were rendered at a stipulated price, such price will be presumed to be the fair market value of the compensation received. In the absence of evidence to the contrary, nothing is free. Every exchange has a number. We proceed to the definition of commercial gain. Regulation 1.613. Gross income derived from business. Subsection A. In general. In a manufacturing, merchandising, or mining business. Gross income means the total sales, less the cost of goods sold, plus any income from investments and from incidental or outside operations or sources. Note the formula. Sales minus cost equals income. Subsection B, state contracts. The profit from a contract with a state or political subdivision thereof must be included in gross income. If warrants are issued by a city, town or other political subdivision of a state, and are accepted by the contractor in payment for public work done, the fair market value of such warrants should be returned as income. If, upon conversion of the warrants into cash, the contractor does not receive and cannot recover the full value of the warrants so returned, he may deduct any loss sustained from his gross income for the year in which the warrants are converted. Regulation 1.616. Gains derived from dealings in property. Subsection A. Gain realized on the sale or exchange of property is included in gross income unless excluded by law. Generally, the gain is the excess of the amount realized over the unrecovered cost or other basis for the property sold or exchanged. The specific rules for computing the amount of gain or loss are contained in Section 1001 and the regulations thereunder. Regulation 1.617. Interest. Subsection A. General rule. As a general rule, interest received by or credited to the taxpayer constitutes gross income and is fully taxable. Interest income includes interest on savings or other bank deposits, interest on coupon bonds, interest on an open account, a promissory note, a mortgage, or a corporate bond or debenture. The money you have breeds more money, and the offspring is taxed. Regulation 1.618, Rents and Royalties. Subsection A. In general, gross income includes rentals received or accrued for the occupancy of real estate or the use of personal property. Gross income includes royalties. Royalties may be received from books, stories, plays, copyrights, trademarks, formulas, patents, and from the exploitation of natural resources such as coal, gas, oil, copper, or timber. Subsection B. Advance rentals. Gross income includes advance rentals, which must be included in income for the year of receipt, regardless of the period covered or the method of accounting employed by the taxpayer. Regulation 1.619. Dividends. Subsection A. General inclusion. Except as otherwise specifically provided, dividends are included in gross income. Regulation 1.6112. Income from discharge of indebtedness. Subsection A. In general, the discharge of indebtedness, in whole or in part, may result in the realization of income. If an individual performs services for a creditor, who in consideration thereof cancels the debt, the debtor realizes income in the amount of the debt as compensation for his services. If a taxpayer purchases his own bonds at a price less than the issuing price, the excess of the issuing price over the purchase price is income for the taxable year. Even the disappearance of a debt is considered a gain. You are richer because you owe less, and therefore you must pay. This concludes the definition of gross income. The net is full. We conclude the definition of income by establishing the adjustments. Section 62. Adjusted gross income defined. For purposes of this subtitle, the term adjusted gross income means, in the case of an individual, gross income minus the following deductions. Item 1. Trade and business deductions. The deductions allowed by this chapter, which are attributable to a trade or business carried on by the taxpayer, if such trade or business does not consist of the performance of services by the taxpayer as an employee. Item 2. Trade and business deductions of employees. Subsection A. Reimbursed expenses. The deductions allowed by Part 6, which consist of expenses paid or incurred by the taxpayer in connection with the performance by him of services as an employee under a reimbursement or other expense allowance arrangement with his employer. Subsection B. Expenses for travel away from home. The deductions allowed by Part 6, which consist of expenses of travel, meals, and lodging while away from home, paid or incurred by the taxpayer in connection with the performance by him of services as an employee. Subsection C. Transportation expenses. The deductions allowed by Part 6, which consist of expenses of transportation paid or incurred by the taxpayer in connection with the performance by him of services as an employee. Item 3. Long-term capital gains. The deduction allowed by Section 1202, Item 4. Losses from sale or exchange of property. The deductions allowed by Part 6 as losses from the sale or exchange of property. This is the final calculation of the gross. The raw material has been gathered. The income has been defined. The ledger is now ready for the deductions. Chapter 4. Section 162, the Factory of Deductions. The Legal Archive, File 4, Section 162, Trade or Business Expenses. We enter now the machinery of commerce. This section is the engine of the deduction system. It defines the cost of doing business. Subsection A. In general, there shall be allowed as a deduction all the ordinary and necessary expenses paid or incurred during the taxable year in carrying on any trade or business. Note the two requirements. First, the expense must be ordinary. It must be normal, common, and accepted in your field of business. Second, the expense must be necessary. It must be helpful and appropriate for the trade. Included in this allowance are the following specific items. Item 1. A reasonable allowance for salaries or other compensation for personal services actually rendered. Let us consult Regulation 1.1627, Compensation for Personal Services, subsection A. There may be included among the ordinary and necessary expenses paid or incurred in carrying on any trade or business a reasonable allowance for salaries or other compensation for personal services actually rendered. The test of deductibility in the case of compensation payments is whether they are reasonable and are in fact payments purely for services. Subsection B, the test of reasonableness. It is, in general, just to assume that reasonable and true compensation is only such amount as would ordinarily be paid for like services by like enterprises under like circumstances. The circumstances to be taken into consideration are those existing at the date when the contract for services was made, not those existing at the date when the contract is questioned. If a salary is excessive, it is not a business expense. It is a distribution of profit A dividend in disguise. The law requires the labor to match the wage. We proceed to the mechanics of movement. Item 2. Traveling expenses, including amounts expended for meals and lodging while away from home in the pursuit of a trade or business. Regulation 1.1622. Traveling expenses. Subsection A. Traveling expenses include travel fares, meals and lodging, and expenses incident to travel such as expenses for sample rooms, telephone and telegraph, and public stenographers. However, these amounts must not be lavish or extravagant under the circumstances. Let us define away from home. If a taxpayer travels to a destination and while there engages in both business and personal activities, traveling expenses to and from such destination are deductible only if the trip is related primarily to the taxpayer's trade or business. If the trip is primarily personal in nature, the traveling expenses to and from the destination are not deductible, even though the taxpayer engages in business activities while at such destination. Subsection B. Commuting. Commuters' fares are not considered as business expenses and are not deductible. The cost of moving your body from your residence to your station of labor is a personal expense. It is the price of existence. Item 3. Rentals. Rentals or other payments required to be made as a condition to the continued use or possession for purposes of the trade or business of property to which the taxpayer has not taken or is not taking title, or in which he has no equity. You may deduct the rent only if you do not own the building. You cannot pay rent to yourself. We arrive at the critical distinction between maintenance and improvement. This is the boundary between the expense and the asset. Regulation 1.1624. Repairs. The cost of incidental repairs which neither materially add to the value of the property nor appreciably prolong its life, but keep it in an ordinarily efficient operating condition, may be deducted as an expense, provided the cost of acquisition or production, or the gain or loss basis of the taxpayer's plant, equipment, or other property, as the case may be, is not increased by the amount of such expenditures. However, repairs in the nature of replacements, to the extent that they arrest deterioration and appreciably prolong the life of the property, shall not be deducted. These must be capitalized and depreciated in accordance with Section 167. Consider the roof of a factory. To patch a leak is a repair. It restores the condition. It is deductible. To replace the roof is an improvement. It extends the life. It is an asset. The law demands to know, are you maintaining the machine or are you building a new one? We conclude this file with the miscellaneous inventories of the trade. Regulation 1.1623. Cost of materials. Taxpayers carrying materials and supplies on hand should include in expenses the charges for materials and supplies only in the amount that they are actually consumed and used in operation during the taxable year. You cannot deduct the inventory until it is used. Regulation 1.1626. Professional expenses. A professional man may claim as deductions the cost of supplies used by him in the practice of his profession, expenses paid in the operation and repair of an automobile used in making professional calls, dues to professional societies and subscriptions to professional journals, the rent paid for office rooms, the cost of the fuel, light, water, telephone, etc. used in such offices, and the hire of office assistants, amounts currently paid or accrued for books, furniture, and professional instruments and equipment, the useful life of which is short, may be deducted. The cost of the ledger, the cost of the ink, the cost of the light bulb illuminating the desk, these are the atoms of the deduction, each one recorded, each one subtracted from the gross. This concludes the factory of deductions. Chapter 5, Section 167, The Decay of Assets. The Legal Archive, File 5, Section 167, Depreciation. We turn our attention now to the inevitable decline of the physical world. Nothing lasts forever. Metal rusts, wood rots, machinery wears down. The code recognizes this universal truth through the mechanism of depreciation. Subsection A, General Rule. There shall be allowed as a depreciation deduction a reasonable allowance for the exhaustion, wear and tear, and obsolescence of property used in the trade or business, or of property held for the production of income. Note the specific terms. Exhaustion, the depletion of a resource until it is empty. Wear and tear, the physical friction of operation. Obsolescence, the loss of value due to technological displacement. Regulation 1.1671. The allowance is that amount which should be set aside for the taxable year in accordance with a reasonably consistent plan, so that the aggregate of the amounts set aside, plus the salvage value, will, at the end of the estimated useful life of the depreciable property, equal the cost or other basis of the property. You are permitted to recover the cost of the machine as it dies. Ideally, the book value reaches zero at the exact moment the machine stops working. We proceed to the mathematics of the decline. Subsection B, Methods of Depreciation. The term reasonable allowance shall include an allowance computed under any of the following methods. Method 1, the straight line method. Under this method, the cost of the property less its estimated salvage value is deducted in equal annual amounts over the period of its estimated useful life. Consider a machine costing $10,000. It has a useful life of 10 years. It has no salvage value. The deduction is $1,000 every year for 10 years. It is a linear, predictable, steady march toward zero. Method 2, the declining balance method. Under this method, a uniform rate is applied each year to the unrecovered cost or other basis of the property. The rate may not exceed twice the rate which would have been used had the annual allowance been computed under the straight line method. This creates a curve. The deduction is largest in the first year. It is smaller in the second year, and smaller still in the third. This recognizes that a new machine loses its value fastest the moment it is turned on. Method 3. The sum of the year's digits method. This is a method of acceleration. Under this method, the annual deduction is determined by applying a changing fraction to the cost of the property, reduced by estimated salvage value. The denominator of the fraction is the sum of the numbers representing the years of the useful life of the account. For a 5-year property, the denominator is 1, plus 2, plus 3, plus 4, plus 5, which equals 15. The numerator of the fraction changes each year to a number which corresponds to the remaining useful life of the account. In year 1, the fraction is 5/15. In year 2, the fraction is 4/15. In year 3, 3/15. In year 4, 2/15. In year 5, 1/15. The deduction shrinks as time passes. Subsection C. Limitations on use of certain methods. Paragraphs 2, 3, and 4 of subsection B shall apply only in the case of property. The construction, reconstruction, or erection of which is completed after December 31st, 1953. The accelerated methods are reserved for the modern era. To calculate the deduction, one must know the future. One must predict the useful life of the object. Let us read from the Bulletin F guidelines regarding the estimated average useful lives of industrial assets. Office equipment. Files, metal, 15 years. Safes and vaults, 50 years. Typewriters, 5 years. Desks, oak, 20 years. Construction equipment. Bulldozers, 8 years. Cranes, steam, 12 years. Mixers, concrete, 5 years. Trucks, heavy duty, 6 years. Motor vehicles, automobiles, passenger, 3 years. Buses, motor, 10 years. Buildings, apartments, 40 years. Factories, 45 years. Warehouses, 60 years. Grain elevators, 50 years. Every object has a destiny. Every object has a date stamped in the invisible ledger when it becomes worthless. We conclude with the concept of the remnant. Regulation 1.16711. Salvage value. Salvage value is the amount estimated at the time of acquisition, which is estimated will be realizable upon the sale or other disposition of an asset when it is no longer useful. It is the scrap value, the price of the metal when the machine is dead. The asset shall not be depreciated below a reasonable salvage value. You cannot write off what remains. Regulation 1.16719. Obsolescence. The depreciation allowance includes an allowance for normal obsolescence. This deduction is allowed in the case of technology that is being rendered useless by improvement in the arts, shifting of business centers, or changes in the prohibitory laws. If a machine is still functional, but no longer efficient compared to new inventions, it is obsolete. It has lost its economic soul, even if its gears still turn. This concludes the study of decay. The asset is exhausted. We continue with the Protocols of Agreement, Section 167, Subsection D. agreement as to useful life on which depreciation rate is based. The law allows for a contract between the taxpayer and the state to freeze time. The Secretary and the taxpayer may, at any time after the date of enactment of this title, enter into an agreement in writing regarding the estimated useful life of any property and the rate of depreciation to be applied. Such agreement shall be binding on both parties. It shall be binding until such time as facts and circumstances, not taken into consideration at the time the agreement was made, are shown to exist. The party initiating the modification bears the burden of proof. If you wish to claim the machine has died faster than agreed, you must prove it. If the government wishes to claim the machine is living longer than agreed, they must prove it. Any change in the agreed rate shall be effective only for the taxable year in which notice is sent by registered mail, and for taxable years thereafter. You cannot rewrite the past. You can only adjust the future. Subsection E. Change in method. In the absence of an agreement under subsection D, a taxpayer may, at any time, elect to change his method of depreciation. He may switch from the method described in subsection B2, the declining balance method, to the method described in subsection B1, the straight line method. This election requires no permission. It is a right of the taxpayer. However, once the switch is made, the taxpayer is bound to the straight line. Regulation 1.16717, Basis for Depreciation, the basis on which exhaustion, wear and tear, and obsolescence are to be allowed, shall be the adjusted basis provided in Section 1011 for the purpose of determining the gain on the sale or other disposition of such property. You cannot depreciate what you do not own. You cannot depreciate what has no cost. The basis creates the limit. The deduction can never exceed the basis. We conclude this chapter with the rules regarding the division of property between the living and the heirs. Subsection H. Life tenants and beneficiaries of trusts and estates. Item 1. Life tenants. In the case of property held by one person for life with remainder to another person, the deduction shall be computed as if the life tenant were the absolute owner of the property. The one who holds the asset holds the decay. Item 2. Trusts. In the case of property held in trust, the allowable deduction shall be apportioned between the income beneficiaries and the trustee, in accordance with the pertinent provisions of the instrument creating the trust. If the trust instrument is silent, the deduction shall be apportioned on the basis of the trust income allocable to each. Item 3. Estates. In the case of an estate, the allowable deduction shall be apportioned between the estate and the heirs, legatees, and devisees, on the basis of the income of the estate allocable to each. Even in death, the depreciation continues. The asset slowly vanishes, regardless of who holds the title. This concludes the file on depreciation. The book value is now 0. Chapter 6. The Nondeductibles, the hard no. The Legal Archive, File 6, Part 9. Items not deductible. We have discussed the allowances. We must now discuss the prohibitions. This section defines the boundary between business and life. Section 261. General Rule. In computing taxable income, no deduction shall in any case be allowed in respect of the items specified in this part. Section 262. Personal, living, and family expenses. Except as otherwise expressly provided in this chapter, no deduction shall be allowed for personal, living, or family expenses. Regulation 1.2621. The following are examples of expenses which are not deductible. Item 1. Premiums paid for life insurance by the insured are not deductible. Item 2. The cost of insuring a dwelling owned and occupied by the taxpayer as a personal residence is not deductible. Item 3. Expenses of maintaining a household, including amounts paid for rent, water, utilities, domestic service, and the like, are not deductible. Item 4. Losses sustained by the taxpayer upon the sale or other disposition of property held for personal, living, and family purposes. Item 5. Commuting expenses. The taxpayer's costs of commuting to his place of business or employment are personal expenses and do not qualify as deductible expenses. The cost of moving your body is your own burden. Item 6. Amounts paid as damages for breach of promise to marry, and attorney's fees and other costs of suit to recover such damages are not deductible. The law does not subsidize the failure of the heart. We proceed to the prohibition on permanence. Section 263. Capital expenditures. Subsection A. General Rule. No deduction shall be allowed for Item 1. Any amount paid out for new buildings or for permanent improvements or betterments made to increase the value of any property or estate. Item 2. Any amount expended in restoring property or in making good the exhaustion thereof for which an allowance is or has been made. You cannot deduct the construction. You can only deduct the decay. Regulation 1.263. Examples of capital expenditures. The following amounts are strictly non-deductible: the cost of acquisition, construction, or erection of buildings, the cost of defending or perfecting title to property, the amount expended for architect services, commissions paid in purchasing securities, amounts paid for securing a copyright and plates, which remain the property of the person making the payments, the cost of a patent, the cost of a trademark, the cost of a brand. These are not expenses. These are investments. They sit on the balance sheet, heavy and undeductible. We arrive at the restriction on family transactions. Section 267. Losses, expenses, and interest with respect to transactions between related taxpayers. Subsection A. Deductions disallowed. No deduction shall be allowed in respect of any loss from the sale or exchange of property, directly or indirectly, between persons specified in subsection B. Subsection B. Relationships. The persons referred to in subsection A are Item 1. Members of a family. Item 2. An individual and a corporation, more than 50% in value of the outstanding stock of which is owned, directly or indirectly, by or for such individual. Item 3. Two corporations, if more than 50% in value of the outstanding stock of each is owned, directly or indirectly, by or for the same individual. Item 4. A grantor and a fiduciary of any trust. Item 5. A fiduciary of a trust and a beneficiary of such trust. Subsection C. Constructive ownership of stock. For purposes of determining the ownership of stock, the following rules apply. Item 1. Stock owned, directly or indirectly, by or for a corporation, partnership, estate, or trust shall be considered as being owned proportionately by or for its shareholders, partners, or beneficiaries. Item 2. An individual shall be considered as owning the stock owned, directly or indirectly, by or for his family. Subsection C4. The family of an individual. The family of an individual shall include only his brothers and sisters, whether by the whole or half-blood spouse, ancestors, and lineal descendants. The law assumes that blood corrupts the market. A father cannot sell a loss to a son. A brother cannot sell a loss to a sister. The transaction is voided. We conclude the file on non-deductibles with the rules regarding tax-free income and idle land. Section 265. Expenses and interest relating to tax-exempt income. No deduction shall be allowed for any amount otherwise allowable as a deduction, which is allocable to a class of income other than interest, wholly exempt from the taxes imposed by this subtitle. You cannot deduct the cost of earning money that the government cannot tax. If the income is invisible to the state, the expense must also be invisible. Section 266. Carrying charges. No deduction shall be allowed for amounts paid or accrued for such taxes and carrying charges as, under regulations prescribed by the Secretary, are chargeable to capital account with respect to property if the taxpayer elects, in accordance with such regulations, to treat such taxes or charges as so chargeable. If you hold land that produces nothing, and you pay interest on the mortgage and taxes on the dirt, you may choose to capitalize these costs. You may add them to the value of the land, or you may deduct them, but you cannot do both. We conclude the list of the forbidden with the rules regarding intent and politics. Section 269. Acquisitions made to evade or avoid income tax. Subsection A. In general, if any person or persons acquire, directly or indirectly, control of a corporation, or if any corporation acquires, directly or indirectly, property of another corporation, not controlled immediately before such acquisition by such acquiring corporation or its stockholders, and the principal purpose for which such acquisition was made is evasion or avoidance of federal income tax by securing the benefit of a deduction, credit, or other allowance which such person or corporation would not otherwise enjoy, then such deduction, credit, or other allowance shall not be allowed. The law looks at the motive. If the purpose of the purchase is to purchase a loophole, the loophole is closed. Section 271. Debts owed by political parties. Subsection A. General Rule. In the case of a taxpayer other than a bank, no deduction shall be allowed under Section 166 relating to bad debts, or under Section 165 relating to worthlessness of securities by reason of the worthlessness of any debt owed by a political party. Subsection B. Definitions. The term political party means: Item 1, a political party. Item 2, a national, state, or local committee of a political party. Item 3, a committee, association, or organization which accepts contributions or makes expenditures for the purpose of influencing or attempting to influence the election of presidential or vice presidential electors, or of any individual whose name is presented for election to any federal, state, or local elective public office. If you lend money to a campaign and the campaign fails, the loss is yours alone. The Treasury will not subsidize the cost of the election. Section 273. Holders of life or terminable interest. Amounts paid under the laws of a state, a territory, the District of Columbia, a possession of the United States, or a foreign country, as income to the holder of a life or terminable interest acquired by gift, bequest, or inheritance, shall not be reduced or diminished by any deduction for shrinkage, by whatever name called, in the value of such interest due to the lapse of time. You cannot deduct the fading of a gift. Time takes the value away, and the law offers no compensation. Chapter 7. The Accounting Periods. The Calendar of Debt. The Legal Archive. File 7. Subchapter E. Accounting Periods and Methods of Accounting. We must now define the temporal structure of the obligation. How does the law measure the passing of time? Part 1. Accounting Periods. Section 4. 141. Period for computation of taxable income. Subsection A. Computation of taxable income. Taxable income shall be computed on the basis of the taxpayer's taxable year. Subsection B. Taxable year. For purposes of this subtitle, the term taxable year means: Item 1. The taxpayer's annual accounting period, if it is a calendar year or a fiscal year. Item 2. The calendar year, if the taxpayer keeps no books or has no other annual accounting period. Item 3. The period for which the return is made, if a return is made for a period of less than 12 months. Subsection C. Annual accounting period. For purposes of this subtitle, the term annual accounting period means the annual period on the basis of which the taxpayer regularly computes his income in keeping his books. Subsection D. Calendar year. The term calendar year means a period of 12 months ending on December 31st. Subsection E. Fiscal year. The term fiscal year means a period of 12 months ending on the last day of any month other than December. The law demands a cycle, a beginning and an end. We proceed to the anomaly of the calendar. Subsection F. Election of year, consisting of 52 to 53 weeks. Paragraph 1. General rule. A taxpayer who, in keeping his books, regularly computes his income on the basis of an annual period which varies from 52 to 53 weeks and ends always on the same day of the week, and ends always A. on whatever date such same day of the week last occurs in a calendar month, or B. on whatever date such same day of the week falls, which is nearest to the last day of a calendar month, may elect to compute his taxable income for purposes of this subtitle on the basis of such annual period. Paragraph 2. Application of effective dates. In any case in which the effective date or the applicability of any provision of this title is expressed in terms of taxable years beginning or ending with reference to a specified date, which is the first or last day of a month, a taxable year described in paragraph 1 shall be treated A. as beginning with the first day of the calendar month, beginning nearest to the first day of such taxable year, or B. as ending with the last day of the calendar month, ending nearest to the last day of such taxable year. The week is the unit, the month is the approximation, the year is the variable. We move to the rules for altering the flow of time. Section 4, 142. Change of annual accounting period. If a taxpayer changes his annual accounting period, the new accounting period shall become the taxpayer's taxable year only if the change is approved by the Secretary. You cannot move the finish line without permission. Regulation 1.4421. A change of annual accounting period includes a change from a fiscal year to a calendar. Be filed on Form 1128 with the Commissioner of Internal Revenue, Washington, D.C. Section 4, 143. Returns for a period of less than 12 months. Subsection A. Returns for short period. A return for a period of less than 12 months, known as a short period, shall be made under any of the following circumstances. Item 1. Change of annual accounting period. If the taxpayer, with the approval of the Secretary, changes the basis of computing taxable income from calendar year to fiscal year, or from fiscal year to calendar year. Item 2. Taxpayer not in existence for entire taxable year, when the taxpayer is in existence during only part of what would otherwise be his taxable year. Item 3. Termination of taxable year for jeopardy, when the Secretary terminates the taxpayer's taxable year under Section 6851. If the danger is great, the year ends today. We must now calculate the obligation for the partial year. Subsection B. Computation of tax on change of annual accounting period. Paragraph 1. General rule. If a return is made under paragraph 1 of subsection A, the taxable income for the short period shall be placed on an annual basis. This is done by multiplying the modified taxable income for such short period by 12 and dividing the result by the number of months in the short period. The tax shall be the same part of the tax computed on the annual basis, as the number of months in the short period is of 12 months. Consider the formula. Income times 12, divided by months. The law projects what you would have earned had the year been full. Paragraph 2. Exception. If the taxpayer applies for the benefits of this paragraph The tax for the short period shall be the amount, which is the same part of the tax, computed on the taxable income for the 12-month period, beginning on the first day of the short period, as the taxable income for the short period is of the taxable income for the 12-month period. The math is inescapable. Even a fragment of a year must be annualized. We conclude this file with the methods of recording reality. Section 4, 146. General Rule for Methods of Accounting. Subsection A. General Rule. Taxable income shall be computed under the method of accounting on the basis of which the taxpayer regularly computes his income in keeping his books. Subsection B. Exceptions. If no method of accounting has been regularly used by the taxpayer, or if the method used does not clearly reflect income, the computation of taxable income shall be made under such method as, in the opinion of the Secretary, does clearly reflect income. Subsection C. Permissible methods. Subject to the provisions of subsections A and B, a taxpayer may compute taxable income under any of the following methods of accounting. Item 1. The cash receipts and disbursements method. Item 2. An accrual method. Item 3. Any other method permitted by this chapter. Item 4. Any combination of the foregoing methods permitted under regulations prescribed by the Secretary. You may choose your method, but once chosen, you are bound to it. The books must match the reality. This concludes the file on accounting periods. Chapter 8. The Tax Tables. The Legal Archive, File 8, Section 1. Tax imposed. We arrive at the final calculation, the schedule of rates. There is no escape from the mathematics. Listen to the escalation of the debt. Subsection A. Rates of tax on individuals. If the taxable income is not over $2,000, the tax is 20% of the taxable income. If the taxable income is over $2,000 but not over $4,000, the tax is $400 plus 22% of the excess over $2,000. If the taxable income is over $4,000 but not over $6,000, the tax is $840 plus 26% of the excess over $4,000. If the taxable income is over $6,000 but not over $8,000, the tax is $1,360 plus 30% of the excess over $6,000. If the taxable income is over $8,000 but not over $10,000, the tax is $1,960 plus 34% of the excess over $8,000. If the taxable income is over $10,000 but not over $12,000, the tax is $2,640 plus 38% of the excess over $10,000. If the taxable income is over $12,000 but not over $14,000, the tax is $3,400 plus 43% of the excess over $12,000. The rate increases. The burden grows heavier. If the taxable income is over $14,000 but not over $16,000, the tax is $4,260 plus 47% of the excess over $14,000. If the taxable income is over $16,000 but not over $18,000, the tax is $5,200 plus 50% of the excess over $16,000. If the taxable income is over $18,000 but not over $20,000, the tax is $6,200 plus 53% of the excess over $18,000. If the taxable income is over $20,000 but not over $22,000, the tax is $7,260 plus 56% of the excess over $20,000. If the taxable income is over $22,000 but not over $26,000, the tax is $8,380 plus 59% of the excess over $22,000. If the taxable income is over $26,000 but not over $32,000, the tax is $10,740 plus 62% of the excess over $26,000. If the taxable income is over $32,000 but not over $38,000, the tax is $14,460 plus 65% of the excess over $32,000. We enter the upper tiers of the obligation. If the taxable income is over $38,000 but not over $44,000, the tax is $18,360 plus 69% of the excess over $38,000. If the taxable income is over $44,000 but not over $50,000, the tax is $22,500 plus 72% of the excess over $44,000. If the taxable income is over $50,000 but not over $60,000, the tax is $26,820 plus 75% of the excess over $50,000. If the taxable income is over $60,000 but not over $70,000, the tax is $34,320 plus 78% of the excess over $60,000. If the taxable income is over $70,000 but not over $80,000, the tax is $42,120 plus 81% of the excess over $70,000. If the taxable income is over $80,000 but not over $90,000, the tax is $50,220 plus 84% of the excess over $80,000. We reach the summit, the absolute limit of the law. If the taxable income is over $90,000 but not over $100,000, the tax is $58,620 plus 87% of the excess over $90,000. If the taxable income is over $100,000, but not over $150,000. The tax is $67,320 plus 89% of the excess over $100,000. If the taxable income is over $150,000, but not over $200,000, the tax is $111,820 plus 90% of the excess over $150,000. If the taxable income is over $200,000, the tax is $156,820 plus 91% of the excess over $200,000. 90.1%. This is the ceiling. We proceed to the alternative calculation. Section 1, subsection B. Rates of tax on heads of households. If the taxpayer qualifies as a head of household, the obligation is adjusted. Listen to the parallel structure. If the taxable income is not over $2,000, the tax is 20% of the taxable income. If the taxable income is over $2,000 but not over $4,000, the tax is $400 plus 21% of the excess over $2,000. If the taxable income is over $4,000 but not over $6,000, the tax is $820 plus 24% of the excess over $4,000. If the taxable income is over $6,000 but not over $8,000, the tax is $1,300 plus 26% of the excess over $6,000. If the taxable income is over $8,000 but not over $10,000, the tax is $1,820 plus 30% of the excess over $8,000. If the taxable income is over $10,000 but not over $12,000, the tax is $2,420 plus 32% of the excess over $10,000. If the taxable income is over $12,000 but not over $14,000, the tax is $3,060 plus 36% of the excess over $12,000. If the taxable income is over $14,000 but not over $16,000, the tax is $3,780 plus 39% of the excess over $14,000. The reduction is slight. The burden remains. We turn now to the taxation of the entity. Section 11. Tax on corporations. Subsection A. Tax imposed. A tax is hereby imposed for each taxable year on the taxable income of every corporation. The tax shall consist of a normal tax computed under subsection B and a surtax computed under subsection C. Subsection B, normal tax. The normal tax is equal to 30% of the taxable income, provided that in the case of a taxable year beginning before April 1st, 1955, the normal tax is equal to 30%, and in the case of a taxable year beginning after March 31st, 1955, the normal tax is equal to 25%. Subsection C, surtax. The surtax is equal to 22% of the amount by which the taxable income exceeds $25,000. Thus, the formula for the corporation is binary. Below 25,000, the rate is 30%. Above 25,000, the rate is 52%. Section 12. Cross-references relating to tax on corporations. Item 1. For tax on the unrelated business income of certain charitable and other corporations, see Section 511. Item 2. For accumulated earnings tax, see Section 531. Item 3. For personal holding company tax, see Section 541. Item 4. For tax on foreign corporations, see Section 881. The corporation has no body to jail. It has only assets to seize. We conclude the file with the subtraction of credits. Part 4. Credits against tax. Section 31. Tax withheld on wages. The amount withheld under Section 3402 as tax on the wages of any individual shall be allowed to the recipient of the income as a credit against the tax imposed by this subtitle. Section 34. Dividends received by individuals. Subsection A. General rule. There shall be allowed as a credit against the tax imposed by this subtitle an amount equal to 4% of the dividends which are received from domestic corporations and are included in gross income. The calculation is complete. The legal archive, file complete. We have reached the end of the schedule. The calculation is finished. The books are closed. The year is balanced. There are no more deductions to claim. There is no more income to report. The bureaucracy is satisfied. You have done enough for today. Let the numbers fade from your mind. Let the structure of the law dissolve into the dark. If you found rest in this archive, you may subscribe to the laboratory to receive your next assignment. But for now, the office is closed.